All right, so on Friday, you have the financial analysis and the forecast due. If you didn't finish the forecast, you can turn them in separately and turn in the forecast later. But get the financial analysis in so I can get that graded. That takes me longer to grade. If you need help, I still have students needing help on the Excel, and it's getting, closer to the due dates. So if you need help with your model, there was one that had missing years, and she sent it to me, and I was able to get it all fixed. So she has a good model that works. So I can clean them up if you're missing data, like you have several years that don't have any data. I can take your file if you send it to me, and I can clean it up so you have something good to work with for paper 4. And then the forecast, just do the best you can. Some of you have easier forecasts to do than others, so it just depends on what you have to work with. I take it in consideration when I'm looking at it.
So Professor, so you said that I can to add it on this one, but if not, it can be due later for 40 minutes.
Yeah, I can grade them in pieces. Yeah, you may not get the grade back for the overall, but I can give you the rubric for what you did do. And then once we get paper 5 is a little bit more straightforward, as some of y'all have seen this before in previous classes. And then you have time to start fixing your papers that need adjustment at the end.
So technically, I'm getting confused a little bit. So with the forecast, after that one, we just have one more paper.
Paper 5, and then you're going to do a group project at the very end to summarize everything. Yeah.
Okay.
We're getting close to the end.
Okay.
So talking about paper 5, you have to get a discount rate. So we talked about the discount rate before. I am creating a video on this one, so you'll have that as well. The thing with the video, though, is it only does one scenario, and you're going to want to do multiple scenarios in this because we want to get to that football chart. We'll probably spend an entire class talking about the football chart. So last class, we came up with the risk-free rate, which is fairly straightforward, and the market risk premium. So now in the beta calculations, we've talked about this before, but let's get into it again. It is a forecast. It has 4 steps. So you talk first is you define the company as cyclical or defensive. There's a few ways you can do this. One is just subjective judgment. You can certainly do that. What do you think? Is it more cyclical? What some students try is they look at market extremes and see how stock did. Obviously, 2008 is a good extreme. The problem with 2008, it was so much in the financials that sometimes stocks, like some tech stocks, actually didn't do all that badly in 08 because they weren't financials. So you have to kind of ask. And the COVID in 2000, some tech stocks did, like Zoom, did fine. So each extreme is its own thing. So that's kind of a challenge. Really, what you want is a normal recession. We just haven't had a normal recession in quite some time. So you have to kind of look. Some of your stocks don't go back far enough. Like DoorDash. How do you even know? I would assume DoorDash would be high beta, wouldn't you? More cyclical, that people are going to order less food at home. I think the biggest issue with me with DoorDash is the tip, because you buy, you say, how much is a typical DoorDash tip? $5-10. That's increasing your cost quite a bit. It'd be easier just to run to McDonald's yourself and get stuff from the store. So you think it'd be high beta, but you don't have any really data to prove that. So you essentially if small firms like that are growing fast, looking at their history doesn't help much because they're just growing fast no matter what. They're just on a tear. So sometimes all you can do is the subjective side. You could look at the industry at market extremes. That can certainly help. And then the cheating one, but it's okay. Look ahead to the history is also okay. Especially here, thinking about the industry. So if you did an industry ETF, like we're going to do in the history, that can somewhat help you. So the history, I think. So essentially what I'm saying, on this number one and on the history, go back and forth and look. You think your firm is defensive, and then you look at the history and they're almost entirely above one. Rethink it, reassess. So the history can somewhat shade what you think about your company. But very subjective. So some are obvious. Sasha's doing IMAX. We generally think of entertainment as being high beta. Is that 1.3, 1.5, 1.7? The history is going to help you with that, but it's going to be a higher beta. IMAX is inexpensive. Although the CEO of Santikos, he said theaters may not be as high beta as you think, because you're thinking about spending $5,000 at Disney. You say, forget that, but I want to do something nice for my family, so let's take them to a movie for $40 or 100. I don't know. I haven't been to movies since you guys were born, so I don't know what a movie costs anymore. Is it $10 a ticket now?
17.
It's more than $10.
17.
$17. Yeah, so family, that's $100 for a family to go out to a movie when you can do everything streaming now. It's kind of, we thought streaming was going to put movie theaters under, but for some reason they're still in business even after COVID. But do think through it, use some logic there. You can look ahead at the history. So before you write this section, you might want to do the history first, get that built, so you can make sure you don't have to rewrite that. But is your firm defensive, cyclical, or somewhere in between? Some of them are very, very obvious. Some of them are less obvious. But the big question you're asking is, in a recession, will they perform above average, average, below average? The question is not, will they do well? Beta is not an absolute, it's a relative thing. So every firm might have some weakness in a recession. People might actually shop less at Walmart in recession than they would have without a recession. But the question is, in a recession, will they do better than the average firm, worse than the average firm, or about the same as the average firm? That's really where the subjective comes in. And recessions is the best way to think about it. It's easier to think about in a recession than thinking about a strong economy. So think about recession, because our minds kind of focus, do better on the negative side of this. That's really where the subjective comes in. And you're asking about behavior of their customers. Is this a firm that customers are going to significantly cut back on because of weakness in their incomes and their revenues? Right. So that's a subjective discussion. But some students have tried to say, hey, look how my firm did in 2008. That works with Walmart. Walmart did it really well in 2008. That gives you further evidence that this definitely is a low beta firm. The second thing is operating leverage. And again, here is the subjective assessment of fixed costs versus variable. Things here we're talking about are salaried versus hourly workers. I think we talked about McDonald's here some. Like McDonald's, we're not talking about the restaurants, we're talking about the franchise. McDonald's doesn't own many restaurants, so they don't have many hourly workers. So make sure you're thinking about the firm you're actually assessing. All right. The level of fixed assets, because that drives depreciation, which is obviously a fixed cost. And other costs they must spend every year. Think about R&D or pharma. Pharmaceutical can't say, you know what, the economy is kind of weak, we just won't do any R&D this year. They're going to have to keep a pretty hefty R&D budget going every year, no matter what the economy is doing. So think at a subjective, and then you can use the chart. But I saved it, but it's out there in Canvas. So you go out under models. It's this one right here, the second to last one, and there's the capital IQ model. And I will add another file. Actually, okay, I did add another file. All right, so the second to last one is for those of you who have negative net worth. And I forget who that is. I know it's Beverly with Starbucks, somebody else too, I think. Forget, there's a couple others. So what I did, so I'm glad I just remembered that. So on this file, what I actually did is instead of doing debt to equity, I did debt to assets. So if you look at a Starbucks, line 2376. It brings in their debt to assets, and then you can see that their debt to assets is really, really high. So not many of y'all need that. For those of you who have net worth that is negative, you can do that. The other file that we have is the one you want to use. You want to use the third one from the bottom, unless you have negative net worth. So Starbucks 2376. There you see there's no. So if you're seeing an NA in value, this is for debt to equity, not for operating leverage. If you're seeing an NA there, use the other file and use debt to assets. Okay. You can't have negative assets. I don't think any firm could ever have negative assets. So that should work fine. All right. So here, go in and find your company. $655. And I've given you gross and net, so you can ignore gross if you want to. What I find interesting in the gross margin is that, to me, is the elasticity of demand. Is this a firm that when their costs rise, they can raise their prices? So I like that elasticity discussion. I think that's important, but you could leave gross margin out. But net margin, definitely talk about it. So obviously Costco has one of the lowest volatilities of net margin out there. Be really careful on your paper. These are not their gross margins. Costco's gross margin is not 0.33%. This is the standard deviation of the gross margin. Make sure you know that. The standard deviation of the net margin. So you use the chart. Do it for your company. Gross for elasticity. Net for elasticity, fixed cost. And then you might do it for competitors. Just to see, the reason I like to do a few competitors is to see, is my company the strange one? Or is it normal? Or is it in line with the rest of the industry? So if we compared Costco to Walmart, they both have very low volatility of net margins, but Costco is by far the king. Very, very stable. That gives you great confidence that this is a low risk company. You can use a lower discount rate because their margins are so predictable. All right. And then the third one, same aspect, financial leverage. Here, just use the chart for your company, competitors. And then don't forget paper 4. Think about the history. And I forget which chart it was, maybe chart 7, was that it? When you talk about debt in paper 4, I think chart 6 is the times interest earned. So if you look at chart 7, so all this table here is doing is showing you their debt to equity as of the last time they reported. But think about the history Is it coming down? Has it been coming down? Is it going up? Did it used to be zero and now it's something, so don't forget what you did in paper 4 to give it some context here on whether or not there's been a radical change. So if we look at Costco, I think I have Costco loaded. See if it's chart 7. That's what I remember. No, chart 6. It is chart 6. If you look at chart 6, yeah, their debt has been amazingly stable between 1 to 1.5. Now this is debt to EBITDA, it's not debt to equity, but it's been amazingly stable throughout. You do have debt to equity on print page 1. Somewhere right here, line 27. So you do have that as well if you want to look at that. So pretty consistent, very stable. So you do want to ask the question, is the last year, because I'm only looking at 1 year, is that unusual or is it pretty much in line? So for Costco, the last year is real similar to the previous years. So I don't have to worry about that. This number used to be 87 or used to be 20. There's no real trend there. So this is debt to equity. On your paper 4, you have debt to EBITDA and debt to equity. Your chart is debt to EBITDA though. So competitors, I think, is interesting here. Just you're trying to decide, because when you get to the history and you look at your firm, you think, wow, I thought my firm's beta was going to be lower. But if you remember from financial leverage that your firm had more financial leverage, that might explain that difference. So that relative to your industry can be real important. So maybe pick 2 or 3 companies to compare. I think the one I did for Costco, I think Bond and he actually did a bar chart where he compared some companies, or at least one of them did that. Real simple to do. It only takes a couple minutes to bring in. You just write the numbers down and create a bar chart. Makes your paper much more powerful in these discussions, because remember, on all of this, it's a relative thing. And it's not just relative to the overall market, it's relative to competitors, because certain industries like utilities have a lot of debt. So you can't just say, wow, my firm has a lot of debt. Well, utilities have a lot of debt. Do they have a lot of debt versus other utilities? So that gives you much better insight in your firm. Okay. And then the last step is history. I gave you this file. Caspian, you get it to work finally? Or who was it that was that you or somebody else? Someone was working with it. Oh, no, it was Omar, I think. It was Omar. So for the rolling beta, I set up a file in Excel using Bloomberg. It won't work here. I don't have Bloomberg here. I wish I did. I like this file better, but you have to be on a Bloomberg machine. When Omar was doing it, for some reason, this right here wasn't working. I have it as concatenate formula. If it's not working, you can just type in your firm's ticker and type US equity, and it will work. So you can just type it in itself if you want to. You don't have to use the concatenate. Once you do this, the nice thing about this, I mean, if you type over, I would try and see if it works, because if it does work, you can then try another firm, and you can quickly collect the data, and you can do, if you want to do like 3 or 4 betas, rolling betas for industry companies, and you can also try the industry you're in as an ETF or even a Bloomberg index. So there's things you can do with this. And the nice thing about this, once you're on the Bloomberg machine, once you change the ticker, all the data comes in. If you do it the approach I'm going to show you next, you're going to have to do a lot of extra work, because you're going to have to go get the data. So that's the advantage of this file. As you sit at the Bloomberg machine, you can get the data really fast. You can copy and paste it as values, and then you have it for the industry, you have it for your competitor, you have it for your company. You do have to decide what date you're going to start. So for Packer, I went back to 1984. If you do an earlier date, you'll get a lot of NAs, and you have to just look and see when did the NA stop, and and start on that year. So if you can compare it to industry, if your firm has a lot of history, what you can do is you can mix and match. So, DoorDash is a good example. So Sebastian's not going to have much history. So he might do DoorDash for 2 or 3 years, and then he might add Uber longer history on top of that, and Lyft longer history on top of that. So he might have a longer line for Uber and a real short line for DoorDash. Put that on one chart, and that gives him some good insight. I don't know who else you can pick besides those firms. I don't know who else is in that industry. I don't think you can do FedEx and UPS. It's a little bit different business. Yeah, if there's some competitors overseas, but then you're bringing in all kinds of issues. So, but this lends yourself to get the data really, really, really fast in a nanosecond. You copy it, paste it. You might paste it in a different sheet and just keep copying and pasting it until you get everything you need. Copy it and paste it as values. And so that helps quite a bit. So that file is out there. It's a fairly simple formula. It just BDH, and it just says bring it in. It brings it in monthly. So works really, really well. But if you don't want to do that, I don't know what's on all these other sheets. That one's blank. So let's go to Yahoo Finance. And let's do, none of you are doing Packer, so I'll do Packer. So you click on Packer, you click on history. One trick that I've learned is before you do anything, change the daily to monthly. Boy, my machine, I did max on the history, and I hit max on the history first, and that wait time was, I went out, watched the movie, came back home, it was just like, took forever. But if you change it to monthly, it doesn't take it so long to dump it. So then you've got it. So you do the history, and then you've got to do this. Now, one thing you have to know about these dates, October 1 is actually October 31st. November 1, I don't know what that is, November 12th. So we're not in November, we're in November, so ignore those. Start with October 1st. Forget about the October 1st. It's actually October 31st, all right? And then you got to do this, which just goes on forever. You got to copy it all. And it says copy link, and that's not what I wanted. So you want copy, and then you want to paste it special as text. So now you got the data. So what do we need here? So I'm going to go down at the end and see what other garbage I brought in. So I brought that in. I think some other stuff down here too. Went a little too far, but now there's a couple problems here. So you notice with Yahoo Finance, you can no longer download because they now have that. It's something you have to pay money for. There's 2 problems with that. First of all, when you copy and paste, you got all the dividends. You got to get rid of those. The second problem is the adjusted close. Because the adjusted close is taking out dividends and stock splits, the adjusted close can be a minuscule number. And if it's below $1, I don't use it. Now, when you used to download it, it was okay because it went out 8, 9, 10 decimal places. But now it doesn't do so like when I was doing Walmart, you had several years that was 10 cents or 1 penny, or I can't remember, than 10 cents, but just 1 penny, 1 penny. So unless it moved 50% or more, it looks like there's no volatility because you didn't, and when they went out 10 decimal places, it worked. So that's just an issue you have here. So what we're going to do first is get rid of the dividends. The way I do that is I highlight everything, and I just sort it by the second column. Column B. And that will get all your dividends down at the bottom. And then you can just get rid of those. Then you highlight again, and now you sort it by date. Get earliest first, and then you got it. All you need is that adjusted close at the end, or you can use the close. So the second to last is close, the last is adjusted close. If you use the Bloomberg file, they're actually using close. So I think I'm going to actually use close here. to get rid of everything but the close. Give yourself a couple of rows at the top. So there's Packer. And then you want to bring the S&P in here. When you use the S&P, do shift 6 GSPC. Don't do the shift SPX, GSPC. I don't know what that stands for, but that's the S&P. And so here we can see Packer goes back to April 1980. So there's no reason for me to do the S&P back to 1922. So I just forgot what I just said, April 1980. So I'm going to change this. I'll do 03/31/1980, go a month before. Nice thing here is you don't have to worry about dividends, but again, start with October. Way down to the bottom, try not to go too far. Copy. But you can, y'all see the advantage of the Bloomberg, right? You don't have to go through all of this. A special text, sort it by date. Oh, why did it do 1985? Did I hit the wrong button? It says 1980. It's not letting me do 1980 for some reason. Okay, well, that's probably fine. We'll just get rid of Packer. So we got January 1985, so I'll just do that. Make sure your dates are lined up when they are. So we got our dates lined up. On the S&P, it doesn't matter which column you use because there is no adjusted close because it's a price only index. So get rid of everything. Except for that last column. So you need the S&P and you need your stock. Now, if you do this approach, you want to do other companies, you'll just have to load the other companies in there and get all the data in there one at a time. I'm starting at $1.73. That's probably okay. So just be real careful when they do those adjusted close. Your really, really low numbers like 10 cents, 8 cents, 5 cents. It's a rounding thing. When it rounds from 8 cents to 9 cents, it looks like it's a 12% increase when it may have just been a 2% increase. It just happened to go over the rounding number. So if you get above $1, you're probably okay. So we're going to do a holding period return. We'll do it for Packer and for the S&P. Holding period return, you do the ending value divided by the beginning value minus 1. So the ending value minus beginning divided by minus 1. Ending over beginning minus 1. Do that for your company and for the S&P. Copy it down. And then we're going to do a rolling beta. And I can do 5 years. So 5 years is 60 months. So go down to about 60 months. And then we're going to use the slope function equals slope. Do your company first, then the market. Because remember, you're dividing by the square of the standard deviation of the market. Whatever you do first is not going to be the market. So you got to make sure you do your company first. There's Packer. That seems too low for Packer, but that's just the starting number. And copy that down. So that's the rolling beta. And then we'll try doing the median, the 10%, and the 90th percentile. Before I do that, I'm going to look at it just like I did with Walmart. I think I showed y'all Walmart before. And just see if there's two. And that looks pretty consistent throughout. Looks fine. The last thing I'm going to do is make sure I don't have a data error. So the very, very last one is 0.89. It still seems too low to me. I'm going to go back to Packer. Go to the summary page and look at their last beta. And it looks pretty good. It was 0.89. My last one is 0.89. So your last beta should be pretty close to what Bloomberg shows, because I mean, Yahoo Finance shows, because Yahoo Finance is doing 5 years and monthly as well. It could be slightly off because well, here I didn't use adjusted close. I used the actual close. That probably gets you closer because I think they use actual close. And I think they might use some of the November numbers, and I'm not using the November numbers. So you might be slightly off, but you're not going to be off more than, if Yahoo Finance is showing 1.2, definitely there's some problem with the numbers or something strange going on. So you can double check that against your last number. So that looks pretty good. So I'm just going to do a percentile of this, lock it in. Do the median, the 10% and the 90th percentile. So the median is actually pretty high. And copy that down. And you graph it. And then you have to clean it up. Gates will let me. So this is you look at your charts, a lot of students, boy, they have a chart that's just really not looking very good, with a lot of errors in it. So make sure you do that. So this would be a terrible chart the way it is right now. We're going to fix it. So we got to definitely get dates in there. So let's bring in the dates. So go to the top of my range. My dates in there. If you find that your dates are not ending where they should be, what happens, some students, they start the dates at the very beginning, not where the 5 years starts, and that throws it off. And then we're going to format the dates. We're going to be using, wow, look at that. We're going to be using year. Hold that. This is one thing I wish Bill Gates would fix. This really irritates me with these charts. I want 2024 to be the last number. I wish they had a way, and it doesn't give you that option to say, I want you to start the axis from the right and go left so that my last date is there. That would be a really, really nice ad for them to do. The only way I know how to get it to work is to change the distance until you can get it to do 2024. So it's just to me random until you get it to work. And then work on don't give me a legend that tells me nothing. So edit the legend, the rolling beta. Make sure you spell it correctly. And move the legend up here. I want to squish it down. It's just not letting me. Ah, come on, Bill Gates. Boy, sometimes he's just really not very helpful at all. Yeah, I can't get it to work. There we go. All right, squish it out. And also look at the bottom. I like to get rid of white space. You might not like that approach, but I like so I can just see the chart better. File legend down. All right, something along those lines. The bottom here is where they are today. So if you're UT Austin and you're using 0.89, you're only looking at 1 point. That's why I don't like people who look up their betas in Yahoo Finance, because that is a very, very low. Packers should not be a 0.89 beta firm. They're at one of the lowest levels they've ever been. Why that's the case, who knows what's going on with this firm? Why suddenly it's so low? The median is around 1.2 or so, 1.25. That seems like a reasonable number. I'll probably use something higher for Packer, depending on their debt and operating leverage. I'll probably use something higher, but at least you have some indication that's well above 1. You can even look at when their beta has been high. You know it's low in 2000 because they weren't a tech company. It dropped in 2008 because they're not a financial services company. Why it's dropped here since COVID, that I can't explain. Not sure why that's the case, but it definitely, I think, justifies above 1. Whereas if you just use Yahoo Finance, you have a really, really low number. I do have a theory I was working on that I haven't had a chance to try is one of the reasons they talk about high beta companies underperforming low beta stocks. I think it might be because the industry's overusing regression betas. So it'd be a test to see if investors are actually using regression betas, then that means Packer would have a really, really low discount rate and people would be valuing Packer as really cheap and they'd be buying Packer. Whereas here, they would say Packer is really expensive, they'd be avoiding it. So that's kind of my hypothesis. Do regression betas actually systematically impact valuations of firms? When betas are artificially low, are people overbuying that stock, which is why low beta stocks do so well when betas are artificially high. So I don't know. You would think the stock market would be smarter than that, but go to UT Austin, that's what they do. They look up betas. Someone said A&M doesn't, that they do it the way we're doing it. So maybe there's a few good schools out there, but I know a lot of students, that's all they do is they just go to Yahoo Finance and they feel like they've finished. So this is far better than Yahoo Finance because you got all of this history. Even better, you do the industry, you do competitors, gives you much, much, much more power in the analysis. All right, so that's the beta. And then as we talked last class, you summarize the table. Definitely do this. All right, so you have the revenue sensitivity, op leverage, financial leverage, history. And what you're going to want to do is say you want some kind of summary here in words, blah, 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 blah. And then you want a range. So for Packer, I would say definitely, if I'm doing Packer, if I'm doing Walmart, here I got Packer up there. Let's pretend we're doing Packers. So definitely a cyclical firm, industrial producer, whatever range. Here I might imply 1.2, 1.5. I didn't do operating leverage, but you might say high leverage, unionized workforce, large fixed assets, something along those lines. 1.2, 1.6. Financial leverage, in line with market and industry. No impact, beta, and in history, low now, but history implies 1.1, 1.4, something along those lines. And your final recommendation, you're gonna say 1.2 to 1.5, whatever. I'm just making up numbers off of my head. Something like this, pretty up. I think Bond did something like this. You look at his Costco paper, some way to bring it all back together. And then these ranges you're going to use. Remember, you got to get that football chart. So this range is going to help you with that football chart. What ranges are you going to use on your beta? You're not going to do ranges on your risk-free rate. You're not going to do ranges on your market risk premium. So beta's the one thing you're uncertain about. You don't really need to do ranges on the others because you use those for all stocks. So there's no impact between companies when you're valuing companies. So there's your final recommendation. You'll definitely put that chart into your paper. Let me show you the video that I'm doing for y'all. I'll have this ready hopefully this weekend. It's similar to what we did last class, but I just fancied it up to make it look like a repeatable file. I even did color coding. Typed in numbers are in green, formulas are in black. Final answers are highlighted. I brought in the charts. There's a treasury. So I'm building everything in Excel. So when I write the paper, I can just copy the charts into the paper and write around it. So you can see the charts I brought in. I cleaned up the productivity chart. You can see, did it a lot fancier. The jobs growth chart, improved that some. So when you watch the video, see how I do it. But try to make it so that it's repeatable, so that you know, if you want to use it, you know, take it with you from college, you want to use it for value in another firm, and you have it all set up. Here's my beta, my final table, with some comments, and then my final discount rate. But you're not going to have one discount rate. You're going to be doing ranges. So, you know, keep that in mind. You need to kind of see what your range might going to be. On this one, I'm just using one. I've got got this chart in from the beta calc analysis. So it's all been, you'll see me building this from scratch. So you can see I'm trying to be documenting clearly as I go. So it makes it much easier for me to use it again. Also makes it much easier to write the paper, so I can just draw right from it. If you build Excel pretty well, paper 5 should be easy to write. So you could probably sit and watch this video and hit it pause and go as you go, you know, as you're getting through the video, build it. So you have it all in one place, ready to write the paper. I brought the productivity in here, the labor in here, so I have the data that I need. I didn't bring in, I think in our video, I brought in the nominal GDP, so you could definitely bring something like that in. So there's other things you could do besides this, but it just gives you a good sense of how you have to document this in a paper. Right, any questions on that? Part of the video I haven't built yet is the valuation. So we'll get into that in the video when I get that built, but valuation, I think the key here is list what you need. Dividend 0, free cash flow 0, short-term growth, long-term growth, in your H, your time period, and then just start building these in. Dividend 0, if we do Walmart, let's go back to Walmart. I will value Walmart. So dividend 0 for Walmart. Way you do that, you go to history and you change it to dividends only. And what you want for dividend 0, you want the last year of dividends. So 21 and 19. Free cash flow, remember here, we're gonna do cash from ops less CapEx. It's free cash flow. Shares outstanding. Free cash flow per share. And remember, this is how the Capital IQ Excel model is going to work, but it's doing free cash flow for the firm. We're doing free cash flow for equity. Why? Because cash from ops is net of interest expense. So it is for equity already. So you don't have to make that adjustment. If you do the way you do in Cat Beckham's class, you're using some kind of operating income before interest expense or whatever, be real careful. If your adjustment is before interest expense, that's for the firm. If it's after interest expense, which is what cash from operations is, it's for the equity holders. So I think we've done this before, but we'll do it again. So there you go into the financials. Cash from operations. You might look through and see there's any unusual activity. This last year is awfully high. That makes me a little nervous to use that. I'll use it, but it's awfully high. 35,726. I don't know what's happened to Walmart here recently. They're doing something right, but I'm not sure what's driving it. Your generation's using Walmart more now. Y'all fell in love with Target here a couple years ago, but it seems like people are using Walmart. I don't know if that's because the economy's worse than people are saying is, or what, or Walmart's just doing a better job. I hate going to Walmart's, but I will buy stuff from them online. And then CapEx you get from the investing cash flows. And you do the net PP&E purchases, 2356. So your free cash flow is your cash from operations minus your CapEx. And then shares outstanding, you get that from the income statement. Do the most diluted number you can get. Diluted average shares, 8109. Free cash flow per share. $90. For most of you, I would use free cash flow per share. Some of you, that's the only choice you have because they don't pay dividends. A firm like NVIDIA that pays like 1 penny dividend, $130 something stock, makes no sense to use dividends. So free cash flow per share would be nice. Now, I'm scared to look at DoorDash. What do you do if your firm doesn't have free cash flow? Looks like they might. Looks like they have free cash flow, so that's good. But what if your cash from operations is a negative number? Call me and we'll figure it out, right? You're more likely what you're going to have to do is a future free cash flow number, maybe next year or something. You can't use a negative number. So long-term growth, I'm going to go up and use what we use for the economy. Expected GDP growth, and for Walmart, I'm going to subtract 1% from that. Because this is a mature company. Makes sense. So if the economy is growing 5.5%, I think Walmart will grow about 4.5%. Where does that come from? Where you got population growth, you have inflation, and you have some productivity pickup. So Walmart, even when they're a mature company, they'll find ways to do things better. 4.5%, that sounds about right. Our population growth is pretty slow right now, worldwide and in the United States. Inflation around 2%, and then give them 1 or 2% for productivity gains, then yeah, 4.5 seems reasonable for a firm like that. And then short-term growth, we talked about that last class, but short-term growth. You got the PEG ratio. You got history. Before history, you have sustainable growth. You have history. The PEG ratio approach, you bring in their PEG ratio, your PE ratio, your PEG ratio, and that gives you expected growth. I think we've already done this for Walmart. We'll do it again. That's under statistics. For PE, that's DoorDash. I was saying, man, that doesn't look like Walmart. I think Walmart's been in the 60s in quite some time. So 28.49. PEG ratio is 311. So expected growth is PE ratio divided by PEG, or 9.16%. Sustainable growth. Here, what I'm going to do, I'm going to bring in Capital IQ. I've already got it built, so I'll just go ahead and grab it. But I'm going to bring Capital IQ. You have some of this numbers already from your paper 4. So you can definitely do paper 4 as well. But what I like to do here, so it will work, is look at some growth just historically. So you can do a 3-year, 5-year, and 10-year CAGR. Now, Walmart, we know we have a special issue with Walmart because of COVID. I'm going to ignore the latest 12 months. I'm just going to do annual numbers. So do a 3-year CAGR, you do the last year, and then you go back 4 years. If you're doing 3 CAGR, you got to have 4 years. So 1, 2, 3, 4, raise that to 1 divided by 3 minus 1. So the last 3 years, their revenue growth has been exceptional. The last 5 years, it's been incredible, even more so, especially when you do earnings. 1, 2, 3, 4, 5, 6. So when we look at earnings, you're going to see what COVID impact it had. But 10 years looks pathetic, because they've struggled with Amazon. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. So you can do that for revenue. You can do it for net income. If we can find net income, there's their, I don't know which line is which. That's EPS. So the EPS has grown 7.5%, 6.4%, 2.06, really, really strong growth in earnings. So you have that history that certainly helps quite a bit. I'm going to say 7.5% for history. And then sustainable growth, what you're looking at is ROE times retention. Gives you sustainable growth. You probably use that in 3013. Retention is 1 minus the payout. And what you want to do here is normalize. So you got to make sure you don't just look at the last year. So for Walmart, if you use the Capital IQ, you go into ratios. Here's the return on equity. And what you'll notice with Walmart very quickly is just how well they've been doing here recently. Their ROE is 18.6% versus 16, 15, 12, 18, and then look before COVID. In the 20s. Then it dropped down in 2019. They were actually in a pretty good trail down. COVID kind of saved them. And they're now back up to 18.6. Pretty impressive. Where do you get the payout ratio? So you can go back to the income statement. The payout ratio here. I wish it would come in freeze framed already for us, but payout ratio here is you've got dividends per share somewhere in here on line 77 and earnings per share on line 74. Let's go back to 2017. Dividends per share. $0.67. Earnings per share. $1.31. And so your payout is your DPS divided by your earnings per share. Then your retention. Sorry. Cap IQ is doing great until just then. And your retention is 1 minus your payout. So if you want to look at your sustainable growth, just take your ROE times your retention and then do it over time. So you can see if anything material has happened. Sort of quick graph to look at it. You see pre-COVID, a big drop. And then post-COVID, an incredible jump back up. If you only use the last year, you're at a really, really high level here. So do you really want to use something that high, 12%? Or do you want to look more in this 8% range? So that's why you want to use a few years to see what's happened here recently. So I'm going to use more of the average, and their sustainable growth to me looks more like 8%, something like that. So those are the approaches you have, and then you have your opinion. And just whatever you think is going to happen, you know, maybe 8.5%. With the discussion, you got curbside pickup, you got home delivery. I mean, it's amazing to me that Walmart now has trucks driving around delivering stuff. That's a huge business shift for them. That's something they've never done before. They have to get drivers, they have to buy trucks, they have to maintain the trucks. And we're talking about a completely different business here. I was shocked when Amazon started doing it. And now I was shocked UPS said they don't care. They can have that business. It's unprofitable business. So all of those are, to me, pretty amazing. Did Walmart have to do that because of Amazon doing it? Or did Walmart see that as an opportunity? So was this a desperation that they had to do it, or was this an actual strategic decision that they made? I would love to have heard their board of directors discussing that. We're actually gonna go out and buy a bunch of trucks, and we're gonna get drivers. We're gonna pay them minimum wage to drive in the city and hope they don't speed. Hope they can find their locations. Hope we know how to set this up. Maybe we can sneak into Amazon and see how they're doing it or whatever, you know. You have to think, when a firm does something like that, that radically different than their normal operations, I always want to hear how to get it set up, how is it working? Why are they doing that instead of curbside, since they have all these stores? You know, it's interesting, but that's the kind of discussion you're gonna have here on your opinion. Remember, on the PEG ratio, you also have Bloomberg. I meant to bring a Bloomberg screen. I forgot to print it out. I'll try to remember to show you all Bloomberg screen. To show you what Bloomberg has. Bloomberg has something I think might be a little more useful than the PEG ratio. They just give you better charts. They give you year by year. It's just better information. It usually doesn't go up much more than 5 years, so that's probably all you're going to have. 5 tends to be the standard. But you need your final short-term growth. But again, it might be a range. And long-term might be a range as well. So you might be using ranges on here, but let's say we're going to use 8.5% or whatever, but you might say 6%, 10%. And here you might use 3.5%, 6%, something like that. You know, so you have ranges in there, so you have some ability to build your football chart. Right, and then you're going to do valuation off of that. The H time period. Remember, on the H time period, if you have hyper growth, keep that H5 or lower. You're just not going to have hyper growth for more than a decade. I'm going to use 2.5 for them, 5 years for full rollout. So you have some discussion here. Should be consistent with what you talked about in your forecast. So we got several things going on with Walmart. You might not want to repeat it all here if you did in your forecasts, but you've got some limited growth in the United States. You have high growth in India and Latin America. You have the opportunity for advertising, which is something new for them. Bring all those pieces together and get some sense, how long is it going to take for them to roll all this stuff out? Very subjective. What you can't do, and I've seen this, you'll get 0 credit if you say this. I think it will take 5 years, so my age is 2.5. That's just, that doesn't tell me anything. You got to tell me, why do you think it's going to be 5 years, right? You got to give me some justification for why do you think Walmart's going to have higher than average growth for the next 5 years. So your H becomes 2.5. Find some way. It's creative writing. You make stuff up, definitely. You do want to think about it from a rational standpoint. And don't forget, we mentioned this before, Damodaran's possible, plausible, probable. Keep that in mind. That can certainly get your range on the upside and your range on the downside. What you think can happen with this firm. All right, and then your models. You need 3 models. Give them a discount. Each model. Capital IQ. You need those models. We will do some relative value here pretty soon. We'll probably do relative value on Thursday night. But you need at least 3 models, and each of them need ranges. So when we do the football chart, you need a football chart. You're going to have given discount model, H model, capital IQ model, and then we'll do a relative value one. You might even do 2 relative values. So you're going to have at least least 4 bars. Some people add the 52-week range. That can be interesting as well. You have to kind of see the 52-week range actually adds much to your paper. A firm like NVIDIA or Intel, it can be pretty insightful. So there are other bars that you can add in there, but when you build it for, especially for LinkedIn, you want to be really fancy in the words you use over here. All right. So I'll try to give you all some ideas of how you can make the H model sound much more sophisticated than it really is, or the dividend discount model. Here they say DCF, perpetuity, that's just not fancy enough. Selected range, even dot, so they don't have very good titles. So you want something that sounds like you've invented some new model no one's ever thought of before. So you want to make it fancy, make it sound complex. And don't put clip art of a football going through this. Don't do that. Keep it professional. That doesn't add anything to your paper, especially for LinkedIn. Okay, so dividend discount model, y'all give me the formula. Let's make sure y'all remember this. Every finance major knows this formula, so give me that one. What is it? Y'all know it? I've done it a million times. 10,000 bucks. Anybody can give me this formula? So that changed my mind later. Dividend what? All right, so dividend 1 or 0, you'll probably use 0 times what? 1 plus growth. You only have one growth right here divided by KE minus growth. KE must be greater than growth. You have no choice on that. That's the reason we're adding in the stock buyback in your market risk premium, so you can make sure you get the KE a little bit higher. H model looks exactly the same. To add in the dividend 0 times H times short-term growth, it's long-term growth. KE has to be greater than long-term growth, not short-term growth on that one. We'll see next class. So one thing we got to do are these data tables so you can show your ranges. It's real easy to do a data table on the dividend discount model because you have a growth rate and you have a beta, so you have 2 factors. I'm going to show you how you can do the H model as a data table. It gets a little complex because you have so many different moving parts, but I'll show you how to do that. And then capital IQ is essentially a free cash flow model, but you still want to vary your beta so that you get some ranges. So this is paper 5 with the exception of the relative value we got to talk about. For relative value, we'll do a relative value analysis, which is really pretty simple. But you also need a relative value because that's one of your inputs to the capital IQ model. So you got to put that in there at the end. So we're almost to the end of paper 5, and then you'll have the video that walks you through it. So, all right, I can tell you are making leaving noises, so we'll stop it there. It's in the syllabus. It shows you're doing the financial analysis, which you follow my Walmart example. I've fixed a few more files this week, so hopefully everybody's got what they have. Follow the Walmart example all the way through. If you have questions, call me. And then if you have your forecast ready, put it in there. But you're really following the Walmart and then put a forecast in at the very end. So that's your paper 4. Very, very clear template all the way throughout. You got your graphs and charts and other inputs that you have. So any questions on this paper? If you don't turn in the forecast, you may not get a grade, but I'll have grade what I have. So read.
Are we supposed to include every single chart from the Excel document?
Well, So the time distance earned, if you have negative numbers, you might leave that one out. Then you have to renumber everything after that. You're not gonna do all the nines, you'll pick one of the nines, 9A, 9B, 9C, 9D, and then take the A, B, C, D out. Doesn't make sense to have a 9C if you don't have an AB. And that might have to be 8 if you don't have times interest earned. Other than that, you're gonna use, they're all gonna be in there. Just like, there's gonna look exactly like Walmart, except you're gonna pick one of the nines, and then you may or may not have the times interest earned. Now, it's possible at the firm, there's some of the charts that might get so crazy, doesn't make sense to show them just because it's off the chart, but they're the best thing to do is if there's 1 year it's really bad, just take that out of the graph and leave the rest of it. So there can be some editing. A lot of times you're going to take the 0.9 and 0.1 out. In fact, probably most of the time you'll do that. You'll take those out. So yeah, you have to use your judgment. You want to change the titles to explain why you're putting the chart in there. It's another paper you can adjust after, you're running out of semester, so you don't want to be adjusting every paper the last week. We're going to be too worn out to do that. All right, any other questions on this one?
The forecast, are we submitting it like?
Well, like we talked about in class, so best way to understand the forecast is go look at some of the examples. So there's plenty of examples in here. If I can get down to a forecast. So forecast. You spend most of your time, probably half the paper on your revenue forecast. How did you come up with it? What assumptions did you make? And then the rest of it, you're just finishing out the income statement and balance sheet. So you spend most of your time figuring out how did you get your revenue forecast. He used revenue per store. And then he talked about how many stores they're going to add every year, increase it with inflation, that kind of thing. So yeah, so you can use the Excel model that we have. There's a few corrections we had to make when how I did the years. Just make sure on that one. If you want to meet with me, it's going to get kind of tough to meet with me because it's Thursday. But I have time by Zoom. I have to teach a class on Saturday and now it's going to grade your papers. So I'm going to be pretty stretched, but tomorrow is probably better than any other time. If you want to go over things, set up a Zoom or call or don't email me and say, can you look over it? Because I can't grade your paper twice. So email me and say, can you look over the highlighted paragraph? I can certainly do that. Emailing me and say, read the whole thing, see if it looks good. It's too late for that. That was something a week ago you could have done. It's just at this point, I got to get them all graded. So that's kind of my focus. All right. Other questions? So we're working on paper 5, which is your discount rate, growth rates, and your valuations. We're also going to add in here some relative value analysis. I'm going to show you how that comes in to your the Capital IQ model. So we'll bring that into the Capital IQ. We'll probably do that next week. So today, what I want to focus in on is setting up your multiple scenarios for paper 5. I want to use the one we've been using. So let me show you how I'd set this up. And you're going to need to do something like this because you've got to get that football chart going. I'm going to show you how we can set this up. So let's say I'm doing Walmart. And so what you're going to do is you're going to have your risk-free rate. Let's say that's 4.4%, whatever the market did today. I think bonds rallied a little today. Market risk premium, let's say I got 4% on that. So no reason to run scenarios here. Then from beta, I'm going to have a base, worst, and best. So my base for Walmart, I'm going to say 0.6. My worst is going to be the higher number. My best is the lowest. So think of best and worst as far as valuation. What gives you the highest valuation? And then I'm gonna have long-term growth. I'm gonna say maybe that's 4%. My worst is gonna be 3%. My best is gonna be 4.5%. My short-term growth, see my base is 6%. Worst case, I'm gonna keep it at 3%. Maybe my best case is 9% because Walmart has been doing extremely well here recently. And then my H here, I don't know if I'm gonna vary it all much, but maybe 2, 1, and 3 or something like that. So I got my assumptions. So how am I gonna put all this into a model? So let's put my free cash flow per share. We did that before, didn't we? Don't we have that number here somewhere? $1.90. We did that last time. So the dividend discount model, H model, we'll put in the base case here. So the dividend discount model, we're going to take the $1.90 times 1 plus our long-term growth divided by risk-free rate plus the market risk premium times my beta. Oh, that doesn't look right. What did I do wrong? Oh, I forgot to subtract growth, excuse me. So 70.57, that looks about right. I know it looks really cheap when you look at Walmart itself. Y'all were asking questions about forecasts, and my brain is not focused here. Yeah, why are Moderna, all these stocks falling? Can you imagine RFK, head of health service? That's going to be so interesting. I read his book.
What was it about?
Well, it's I don't want to be political, but it's not very pro Fauci in the say the least. It's not very pro Bill Gates. I don't know if he's lying about Fauci. I don't know why Fauci didn't sue him, because it would be pretty clear defamation and who wouldn't want to sue Kennedy, you know? But I don't know. It seems, I don't know. It's a very scathing book on Fauci, including some things that are really pretty amazing. So they're trading 84. So my valuation looks low. That's fine. All right. So the first thing we're going to do is we're going to, now you can do a data table if you like. I don't really like data tables anymore because they're hard to manage. So what I'm going to do is I'm going to put my beta up here. I'm going to put my long-term growth here. And when you do your betas, you start with the high end. So I'm going to start maybe 0.9. That's probably too high, but I'm going to start 0.9 and I'm going to come down to maybe 0.4. 0.9 is awfully high, but yeah, I'm pretty sure they're not 0.9. So when you do your table, you want the lowest value in the far northwest, and you want your highest value down in the Everglades. And in my growth rates, I'm going to start at, say, 2.5%, go up to maybe, I think 5 is going to be too high, but we'll try it. And so all I got to do is just bring in the numbers that I need. So I need my dividend. So essentially you set up the equation. So we got free cash flow 0 times 1 plus growth divided by risk-free rate, market value, risk premium times beta. So my free cash flow is $1.90 wherever I put that. times 1 plus, I mean, I'm gonna lock that in, right? So that's what the data table is doing. I don't like the data table because it makes it really hard to edit and change things. So I'm gonna not use the data. I'm gonna build a data table by hand. Times 1 plus the growth rate here. I gotta lock in the column there. Divided by, oh, I forgot it again. Why did I forget up here? Minus the long-term growth. I don't know why I forgot that twice. So my risk-free rate, going to lock that in. Plus my market risk premium, lock that in. Times my beta here, lock in the row. Minus my growth, lock in the column. One thing I like to do is find my base case and put that in there. So my base case was 0.6 and 4%, 0.6 and 4%. 7057, is that right? That's right, so I've got it. So now I can copy that down, copy that across. So I've got a range. You can see at the very end, it's actually not too bad. I got up to 199. That's actually not too bad. Then you want to fancy it up, but you want to get a table like this into your paper. I got to bring y'all the one they showed in my CFA research, my CFA exam on Merck. It's so old, but I kept it because it was, in fact, I structured a lot of this class after that. I think I counted 130 something scenarios that they did in that one. They varied the risk-free rate and the market risk premium. I don't want you to do that. That's a little much. I don't believe in varying that because those are numbers you use for every stock. So it really doesn't matter if you vary them because you're trying to figure out if your stock's expensive or rich versus other stocks. So there's no reason to vary something that you're using for every stock. They varied the growth rate, definitely. They varied the beta, definitely. So, you know, and pretty it up as much as you can, make it look professional here. And then what you're going to do is you're going to add some color coding. So you put the current price in there. Current price is, I don't know what this thing is right here. Anybody know what that is? Did they really drop to $67 today? Have y'all seen something like that before? Is that a glitch in the matrix? Is
I read about that somewhere.
that every stock or just them?
It happens randomly, even on Google too, when you look up stocks.
No, wow. That's interesting. We had that, wow.
It freaked me out once on earnings.
Oh, wow. What happened? Is there an article on that today?
I read.
Anybody see anything?
I don't remember where it was, but I looked it up because I was like confused about that, but
That is
I don't know,
bizarre.
on Google or Yahoo Finance, it always displays just like that.
Y'all see anything?
Only
I was teaching a class at Texas A&M, and that was right in the middle of that big blow up. And boy, if I'd seen it, I've been trading, but I was in class. But boy, if I'd seen that there was a major blow up, there was some glitch in the system. Boy, I would have been buying options on that one. It was like I was so irritated in the class. It's like you guys just cost me a fortune here. But that was I forget the name of that company, but they had a blow up and it was like that, just everything fell apart for, I think the Dow fell like 1,000 points and then came right back up.
Is that what you're talking about? Like with Berkshire, would it drop from like what?
No, it wasn't just Berkshire, it was the entire market.
Oh, yeah, I saw some guy.
There was some glitch, something was and I don't know if they let people keep their options when they did that because it was pretty famous, but it's may have been before you were born because I can't keep track of dates. All right, so what we're going to do here is we're going to color code it. So why do you want to color $35? You think Walmart's worth 35 bucks and is trading for 70. Does that sound like it should be red or green? So we're going to say if it's less than that, make it red, all right? And it's greater than that. Gonna make it green. Right? Oh, I did the wrong number. Ah. Sorry about that. All right, I'm gonna change this rather than what's the current price? Sorry. I don't have to go back and read everything. So the current price is I'm sorry, I got distracted by the market, the blow up in a market like that, and every stock doing it. I've never seen that before, actually. It looked like it lasted what, about 3 seconds. So 84.47. There's got to be an article out there. All right. So you want something like that in your paper, long-term growth, you can, what I like to do is this. Something like that, just pretty it up. That look professional. Y'all are better at this than I am, but y'all make it look somewhat professional like that. And then the last thing you can do is for your football chart. So for your football chart, now my base case was where? Right here. It's a little too far off. So you really want your base case to be somewhat in the middle. So I might start this at 0.85. See if I can move this over. That looks pretty good. So for your football chart, you're probably going to be somewhere like in here. So you want to highlight the section, and that's what you're going to build your football chart off of. Your football chart's going to say you think it's worth somewhere between $56 and 104.50. Growth rate up to 4.5, as low as that. Betas between there and there. So I might manipulate this a little bit more because sorry. Really want this more in the center. So you really want to move that so it's your base case is as close to the center as you can get it. I think I went the wrong direction here. Yeah, I'm getting closer. So there's some manipulation. So I'm trying to get my $70 as close. Does that look pretty close to the center? That's 4. That's 6. So it probably needs to be 1 over. That went the wrong way. That looks pretty good there. There's 5. There's 5. So that looks good. And so my main category, my main focus, maybe like that. Right? You'll get the point here. You want to have a range that you think is acceptable range. Now, what happens if some of these are just off the charts? So you could tell it that if it's greater than, say, some number of $200, just black it out, completely black out the cell so that doesn't show. The advantage of this is the fact that it's not a data table, is you actually can go in and you can actually black out some of these. You have to take the conditional formatting off, but you can actually go in and, you can actually do that. I don't know why it's not letting me do that. So you can do something along those lines just to black those out. You have to do that if you get a negative number, obviously. So negative numbers, you just have to take them out. But you see the huge advantage of doing it not as a data table. Data tables, if I did a data table, I can't hit delete. It's gonna scream at me. Have y'all done data tables before? And you're entirely at Bill Gates' mercy. So, well, all the data table is doing is these, are these, exactly what we're doing here. I mean, that's all the data table is doing. Very, very straightforward. And so,
I was gonna ask you to go over the formula again, I'm off like 27.
20 cents. Okay, you have $1.90 for your free cash.
Yeah.
Yeah, it should be exactly right. So you should have $1.90 times 1.04. You have your risk-free rate calculated correctly, 440 and 4%. And 0.6 for your beta. Yeah. I don't know how if you be off a few pennies. It should be exactly the same. What number are you getting?
I'm getting 39.13.
Or this one right here or up here?
Well, I guess it's long-term growth. The first growth, which one is that one?
This 275?
Base growth,
Huh?
for in the equation, the first G.
That's this.
That's the base. Or is
That's-
that-
Well, it's these numbers down here. So my base case was 4%. My base case was 0.6. So I made sure my base case matched. I got 70.57 in my base case. There's my 70.57, 4% growth and 0.6 beta.
And then for long-term growth, which one are you?
Well, that is long-term growth. For the dividend discount model, there's only one growth rate. That makes sense?
I can ask you.
All right. Everybody see how you do that? You don't want a table like this in there. And then for the football chart, given the discount model, we're going to be going from 53.15 up to 120.62, and our base case 70.57. So I don't suggest you do your football chart from 38 bucks to 363 bucks because this is going to look ridiculous. All right. Everybody can build this table. Any not able to do this? Now, if you do it as a data table, which is fine, if you do it as a data table, you have to have the denominator and all these pieces because the data table has to know you're changing beta. So you can't have the risk-free, you can't have the KE as one blob of a number. The data table has to know beta is one of those inputs and exactly how it's the input. But I think it's much easier to do it this way. You're especially going to see it when we do the H model. So H model gets really quite difficult to do. All right, no questions. If you look at some of the old papers, I don't know if I still have his paper up or not. I may have dropped it. You'll definitely see data tables in here. Hey, let me open it again. We're not doing technical analysis this time. We're not doing the start. So you can see how he did it. See how he blackened out these parts down here. It's a little tough with the data table because you have to do the conditional formatting in a particular order. Otherwise, you can't do that. But he did it as a data table. I can tell that's a data table. He didn't label this side of it, so it's hard to know what that is. But all right. All right, so let me show you this. Hopefully no one's on their phones, although I see a couple people. So how do we do the H model? This is really rough. All right, let me show you how I do it. You're probably gonna laugh, but I do want to try to get one in there. I think it'd be really impressive on LinkedIn to do something. So what do we have with the H model? So you have the beta, that's no different. We don't need to change that. So we can keep that the way we had it. What about the upsides? So, I mean, so this is going to be our denominator. So we got a risk-free rate. Market risk premium, I'm gonna go get those so I can deal with this a little better. So I have my KE. My KE is gonna be risk-free rate plus the market risk premium times beta. All right, that's my denominator. This is where it gets complicated. So we've got long-term growth. We got short-term growth. We got the H. Let's take the long-term growth and keep it similar to what we had before. Short-term growth, I'm going to vary it from 3 to 6%. The 9%, excuse me. I'll stop it there. That's good enough. My H. I'll vary that. I forget what I said I was going to do. That's good enough for our purposes. All right, so my numerator is going to be my free cash flow per share times 1 plus my long-term growth plus my free cash flow per share times my H times my short-term growth minus my long-term growth. That's my numerator. Everybody agree with that? If I confuse on that, remember the H model. Taking free cash flow 0 times 1 plus long-term growth plus free cash flow 0 times H times short-term growth times long-term growth. That's the numerator. The denominator, which we're also going to have to work in here. Your KE minus long-term growth. All right, so here's where it gets a little tricky. So we're going to take our numerator and lock in the column divided by our denominator. Lock in the row minus our long-term growth. Lock in the column. Copy that down, and it's going to be weird. Now, the reason it's going to be weird, we'll see, but this one actually doesn't look too bad. This actually worked pretty well. What I've seen sometimes is the numbers, the bounce don't go in order. And it gets frustrating because they're not in order. So you have, it kind of jumps around. I don't see that here. Y'all see anyone where like it goes higher, then goes lower? It looks like it's pretty well set across. I don't see issue. And so when you set it up, you're going to have to work on them. I don't have the formatting, how you get the formatting up, but you do have a pretty good model here where we can take additional formatting that's less than current price. Red. It's greater than the current price. Doesn't look radically different than the previous one. Let me get my base case in there so I know what I'm looking for. So we've got dividend, our free cash flow, 0 times 1 plus my base case, which was 4% plus that times my H times short term minus long term divided by risk-free rate plus market risk premium times my beta minus growth. Base doesn't like that. Left out of parentheses right there. That looks about right. 73 bucks. 73.29. I'm going to try to find that in this 73.29. Oh my word, where would it be? So that's going to be the challenge. You got to somehow get your base case in the middle of that chart. All right. What is my base case? I got long-term growth at 4%. My short-term doesn't quite hit there because my short-term is 6. So it's going to be a little tough. It's going to be somewhere. So maybe your actual case is not going to be in there, but you want to get somewhere in the ballpark. And again, you want to find, let's see how many we have. We have 11 columns, so we want to go over 5. So somewhere in this range. It's my main case. All right, so you get something very, very similar using the H model. It is possible, right? Could you do this with a data table? I don't think it's possible. I think the data table is going to blow up. Bill Gates would have a fit. So, but if you do it like this, it can actually work. So let me go through this again. Let's everybody follow me. You see what I did here? I put my 3 assumptions from the numerator here. Long-term growth, short-term growth, and H. And so the numerator is, I need that dividend. And then you just multiply that out all the way across. So you get your numerator. That is the actual numerator. Right? Everybody's clear on that? Any questions on that? All right. And then up here, I like to put out the entire KEs, just it makes it a lot easier. If you don't do this, then you're going to have to go search for those things and lock them in. You could do that, but I like to do this. Then the question is, how do you format this for making it a table? I think you want to show all of these pieces. I don't think you necessarily need to show this. So you probably would want these 3 pieces in there. So you can probably do better than that, but something along those lines. So you have it all in there. I'm going to move this football thing down somewhere else. Between Bill Gates and Zoom, it's really very difficult, but I'll get it to work here. But something like that gives you everything you need, so you can see your growth rates, your H's, everything's in there. You need all of that in your paper, and then your risk rate, market risk premium. I don't have a room to put beta in there. Put the KE in there. Right, I think that would look pretty decent in your paper. And so now we have for the H model, 54 to 110. Your low is 54. Your high, 110. Your base, 73.29. Any questions up to there? Okay. Have y'all done a football chart before?
What was the base case, K? With HMO?
Well, that's the 0.6. So it's 6.8%. You can't find my actual base case in here because that's gonna be a challenge of this, guys. I can't do the 4 and the 6. If I change this, if I do that, I would get it. It should give my, that should give me my base case right here, 73.63. I can't remember what it was, 73.29. I'm still not seeing it. So I think my H is off. Maybe that's 2. Yeah, there it is. So you might check it like that, just force it to equal and then go back just so you make sure you have it. But it's pretty close. It's in there pretty decently. Other questions on that? So if you think about the football chart, which is going to be pretty important to your team's final conclusion, you're probably going to have a football chart for each one of your companies. So we're going to have 3 models, maybe 4. So you're going to have dividend discount model, H model, and the capital IQ model. I'm going to show you, we're also probably going to do a relative value, and I'll show you the relative value. That one's the easy one. I'll show you that one probably next week. So you're going to want those models. You need them defined over here. So a good way to do this is go onto YouTube and do football chart stocks. There's all kind of people that show you how to do it. Grammarly, commercial every time. So you're going to do a sidebar. And the way you have to do that is you have to trick it. He didn't do a good job of lining up. He hasn't started yet. Essentially, you're going to trick it so that it's going to be a stacked bar, but then you're going to eliminate bottom side. So what you want it to be, so the first part of the bar is going to be your low valuation, and then you're going to get rid of that. So your bottom side is going to be there, and then you want your top side there. You're actually not going to show your base case in here. It's going to be somewhere in between. All right, and he'll show you how to set it up. The key is this right here. You see what he has there? Let me snip it for you. So we've got our minimum. We have our max. Then you want the difference between those two in between. So essentially what you want is a stacked bar. When you put these two together, you're going to limit the minimum. So the minimum is going to be 53.15, and it's going to add them together. And so he has the max, the difference, I mean, the min, the max, and the difference in between. All right. So write that down somewhere so you can see that. That's how to build. How many of y'all built the football chart before? Here, anybody? See your first football field chart? All right. Some of y'all, I mean, if you haven't seen one before, I'm seeing them all the time. It was like 10 years ago, I never saw one, and then suddenly they were everywhere. So someone started this probably at Goldman Sachs or JP Morgan or somewhere. It just became really popular. I don't like this one he has here. It's just not that beautiful. So yeah, he's building it. So you can see, let's see, we can pick the chart. So he's selecting the charts here. Selecting that one. He's got 3 bars. Like, why do you have 3 bars? But you actually have 3 in there. You have 3. Why don't I have 3? Like,
Joe, grab the whole thing. With the labels.
even with the labels, I don't know how that would change it, but.
But I think, yeah, you still have to grab the top label as well.
Really? Why do you think that's the case?
And you might need to take off football chart.
Yeah, it's still not giving me 3 for some reason. I'm not sure why that is. But anyway, so, yeah, mine looks exactly the same as his, doesn't it? It should be. You got the 80. You got the 80. You got the, let's see, the first one is 60 and 40 and 100. So, yeah, I'm just not. Let's see why I'm not getting. So Bill Gates is messing me up for some reason. So, all right. So we'll challenge someone in the class to figure this out after you turn in paper 4, and you can show the class 2 semesters ago. Bond showed the class how to do it. So anyone can figure out. Anybody see what I'm doing differently? You takers?
Maybe it's a chart versus football chart.
I need to pick a different chart.
Yeah, I think it might be. Or you can see 3D of that, maybe more, like look at more charts, because those only look like they have 2 bars. Yeah, for that one. Or like the one on the, yeah, then you move into. There you
That's
go.
the one we want.
Yeah, it's on the right. Okay.
But that's 100%, so we don't want that. Yeah, I don't know why I don't get the gray bar up at the top. It's just not. It's not giving me the gray bar. That one looks correct there. Yeah, there we go. Okay, took me forever. I don't know what the other 2 were. All right, so pick that chart, but I don't know what that chart is. Does it have a title? Doesn't say what it is, but anyway, that's the chart. All right, so pick the chart, and then what you have to do is you got to take out the bottom and take out the top. So anyway, we'll take a volunteer in the class to help us. But you don't delete it, you actually change the fill. So our upper side is 110, so we need to take this out. And then you have to change the formatting here. We'll go up to, let's go up to 120. That looks pretty good, except for we have this white area here. So I have to watch the video a little bit more to see how he got rid of. He doesn't have the white area, does he? He has the line there somehow. Oh, he probably did transparent, right? So that's probably the issue I have. The fill needs to be no fill, and I don't see that as an option anywhere.
Okay.
Where do you see? Oh, there. So you want that to be no fill. You want that to be no fill. I don't see the no fill here. There it is. Oh, it's hidden. All right. And then you got to get the actual dollars in there. And then what you're going to do, you might have to do this manually, but you want the current price in there. So our current price is whatever it was, 84 something, 84.47. So you want to actually put the current price in there, 84.47, somewhere around in here. You may have to actually put a bogus one in there so you can find the 84 and you put the current price right in there. And you've got 2 models. You can have it say exactly that. You don't have to be real fancy with the titles. All right. So we're gonna have 4 bars in ours. So you're gonna have to get it set up so it works. Hopefully you do better than I did. I don't know if these usually start at 0. I don't think they all do. Those do. That one doesn't look right. It looks like y'all, I don't know if you necessarily have to start at 0. It leaves a lot of white space on this side and none over there, but I don't know. If y'all see one that doesn't start at 0, I'd be curious to see what that looks like. So, y'all, does that bother you to have that much white over there? I guess it's okay, but I mean, if you're doing a stock that's like $500 or something, you know, it seems like you'd want to start at like 100 or 200 or 300 or something. All right. So what you're going to do with your final group is you're going to have these on your executive summary talking about the upside versus downside potential versus the current stock. The other thing you can do in here is, see if I can do this once more. You can put the 52-week range, the exact same thing as before. So I would do Walmart, see if they show the 52-week range right here. Pretty wide range. So 49.85, 85.79. The difference in there. Let's see if I can do it one more time. I'm always flirting with disaster here, but so see if we can find it again. It worked that time. Why did it work that time? I don't know. Ah, I did it again.
Can we select the one?
Oh, and then change the range. Oh, why did it do that? So it messed up again. So anyway, we'll have to figure it out. I don't want it saying high, low. I messed up something there. So this one's not the right graph. It went the wrong direction. So you have to experiment with it some. But anyway, the 52-week average, you can put that there. Why do you do the 52-week range? The reason you do that is give you some credibility that the market has been around your valuations this last year. It's not like you have it between $20 and $100 and its 52 range is $120, $150. You want to make sure that 52-week range is overlapping you somewhere. You don't be so crazy in the last 52 weeks, no one's been in the ballpark of what you think. All right. So it might actually change your valuation. I wish I were a little bit better at these charts. The only time I do football charts is this one day of the year when I'm showing the class. And so it's kind of crazy. Anybody want to volunteer to demonstrate it to the class on Tuesday? Any takers? All right, we'll see. All right, so you want to get that in your paper. The goal here is we get it set up correctly. I do have this one looking pretty good. The goal here is upside versus downside. You'll actually calculate the upside versus downside. So the upside is your high divided by the current price minus 1. So you have 40% upside. And your downside is your low divided by current price minus 1. So pretty well balanced. Walmart looks fairly decently valued, maybe a little expensive. So upside downside is your key. You want more upside than downside. If you can somehow do that, find stocks. This is actually a really good way to look at 200, 300 stocks and try to find those that have a significant, you can actually do a ratio of the upside to the downside. and have a list of 200 stocks that you valued and just sort them by the upside versus the downside. And that gives you some sense of what stocks are going to have the most impact on your portfolio. It's not a bad way to screen stocks at all. All right. Any questions on that? All right. Y'all are all thinking about paper 4, I'm pretty sure. But that's all right. You got to think about this on Tuesday or on Sunday. So, all right. The next topic I'm going to go into is relative value analysis. Let me pull it from my investment class. Some of y'all seen this before, right? In my investment class, Beverly's seen it twice before. Did you do this presentation, Beverly? Or is it too long ago? She's seen it twice. All right, so relative value, what are you gonna do with relative value? It's going to be another bar on your football chart. So you've got you have 5 bars, right? Even discount model, H model, cap IQ model, relative value, and then your 52-week highs and lows. All right, so 5 bars. That's going to look pretty impressive to have 5 bars in there. And on the relative value, this is going to be one of these. I'm going to show you a file. We'll talk about this more next week because I want to get into specific. Let me show you one from last semester. Let me show you this one. So this comes out of Bloomberg. It won't work on this machine, but I do have the pace values. So all of you are going to use this model for your company. It should work well for your company. It's set up in Bloomberg. You'll have to go to Bloomberg to get the data, but it's all set up. It brings in 3 ratios. It brings in a PE ratio, an EV, the 12-month sales, and a price to book, and 4 ratios, and EV to EBITDA. Brings in 4 ratios. The EV to EBITDA I have found to be pretty suspect and a bit of a challenge for some companies. But I bring in 4. You'll probably use 1, maybe 2. It depends. Remember that the capital IQ model is set up on EV to EBITDA. But that's unfortunately one that doesn't quite work. So we'll have to talk about that model, how we can switch it to use one of the other ratios, but you should have no trouble to do that. EV to sales, you'll have cells in that model, so it's not that difficult to set up an EV to sales. So when you paste the values, if you look at this, it gives you PE ratios as far back as you can go. So you'll see when you do the model, if you want to start at the earliest date you can. So you might, it's like 12/31/1980. Bloomberg will bring that in, but you'll probably get a lot of NAs. And what you do is you go down and figure out when the NAs stop, and then you copy that date up to as your beginning date. So you want to see when does the data become available. So like if you're doing DoorDash or Coco, right, Jonathan, you may go back 5 years maybe. That's all you're going to have. So you're going to have to start pretty recently. So you go as early as you can, then you change your beginning date so that it reflects whatever data you have available. Sometimes I try to get all 4 of them, but you can notice with EV to EBITDA, there's just very unreliable. The second thing you're going to do is this one right here is which industry are you in? You'll have to know your symbol, but S5 S is the staples. The tickers are here at the end. So you want to bring in your industry. So I have that set up. So you pick your industry, your sector, and it's going to bring those in for your sector. All right. And then in the output, this is what we get here. Let's look at, I think this is Walmart, but it sure doesn't look like Walmart's numbers. What is showing up there? This is actually Starbucks. Someone's doing Starbucks. Is that you? Okay, so Beverly gets to see her old numbers here. So here's Starbucks. Let's look at EV to sales for Starbucks. And we'll talk about why that makes most sense. So Starbucks versus its industry, their median historically is they've traded 127 times more expensive, 127% higher than the industry. So you take their PE ratio or their EV to sales and divide it by the industry's EV to sales. And this is them on the median. So historically, Starbucks has created extremely expensive to other consumer discretionary stocks. Twice as expensive. Today, or when I did this is as of July. As of July, they were only trading 19% expensive. Okay. So they traditionally trade 127% expensive. Now they're only 19% expensive, which means right now they're trading 47% cheap through history. Okay. You can also graph this if you like and see how long this cheapness has been going on. You can see a lot of it was early on. In the last few years, this is what Beverly's going to use to come up with what she's going to do in the capital IQ model. She's probably going to go to this range, which is between 1 and 2, looks like. Between 1 and 2. Maybe she picks 1.5, but some ratio that's going to make sense for her firm relative to the market or to your industry. But you can see that early on, they're very, very expensive, and they've been a lot more stable here recently. I also do the exact same thing versus the S&P 500. So historically, they've traded 51% rich, and that's how you state it in your paper. Historically, Starbucks has traded 51% rich in the market. Today, they are 3% cheap to the market, so are trading 36% cheap to their history. Y'all get all of that? Now we know Starbucks has been struggling. I think their revenues actually fell this last year, right? For like the first time in a long time. They got a new CEO, so that kind of.
And then that boosted it back up.
After
I got this year, boosted it back up.
Yeah, that's getting to Chipotle's CEO. I don't know if Chipotle's recovered from losing a CEO. So they've traded 51% rich. What does 50% rich mean? You take their EV to sales for Starbucks and divide it by the EV to sales of the market. That gives you 1.51 history. Today, you take EV Starbucks today versus EV to the market today, and that's 0.97. I know that seems really simplistic, but that's how it's done. It's just a real simple look. So they used to be an expensive stock. Now they're trading below. And then they're actually trading, you take 0.97 divided by 1.51 minus 1, you get that they're trading 30% cheap. Not to the market, but to their history. All right. These are easy sentences to put into the paper. Pretty straightforward. If you could say that, in an interview, it's like, man, Starbucks has traditionally been a pretty expensive stock, 51% rich, but they're actually trying. What's another way of saying this? Not cheap. You can say they're trading a 3% discount to the market, 51% premium to the market. So you can use rich or cheap or premium or discount. So historically, they've traded at a 51% premium to the market. Now they're a 3% discount to the market. Is that exciting? Well, that's exciting unless something has radically changed with this firm and they're about to, go under or whatever. So it'd be interesting now with the new CEO, if they're now trading rich again, trading at a premium again. Probably they are. It's hard to say. One thing we do know, and I don't know if it's captured in these numbers, it probably is somewhat, is the industry, restaurants got really, really expensive a couple of years ago. I mean, if y'all see Chipotle a few years ago, I mean, it's pretty amazing. And I can never remember Chipotle Mexican Grill, right? I can't remember what it all stands for. But just shot up. And I don't know if Starbucks did that. That would be interesting to see if Starbucks did that, but for some reason, restaurants, especially Chipotle, but a few others just shot up all at once. And there was a lot of articles like, why are restaurants so high right now? Some people say it was post pandemic, people are getting out more, but that's true for a bunch of other things too. So I don't know why suddenly, were y'all rushing the Chipotle there for a while for no reason at all? So I don't know why suddenly it just shot up like that. It has come back down, but it's still at a fairly massive level. A PE ratio of 55, which is awfully high for a restaurant like Chipotle. So pretty amazing. And Starbucks maybe or maybe not did that. I'm not sure. Not really, right? You don't see that with Starbucks. So it's not just that Starbucks has come down or stayed flat, but they did it while the industry just had this incredible shot up. So you might ask the question, why didn't Starbucks join in with the rest of the industry? What was going on? Why were people going to Chipotle but not going to Starbucks? So part of this is Starbucks not doing well, but part of it is also the industry just for some reason going crazy. We do it on a PE ratio basis. You can say Starbucks has historically done what? Traded at a what to the industry? What kind of premium? 75% premium to the industry. Where are they today? 20% discount. So how cheap are they? They're trading 54% cheap to their history. So Beverly's going to decide, are we at an unusually low level now? Are they going to get back to a more normal level? And so when she does the capital IQ chart or Excel model, she's got to pick a good level for this. So she'll say, hey, I think 20% cheap is too much. 175 is too high. So look back at the history. I think they should be trading at a 5% premium to the market. Currently, the market is at 2.3 times. They should be 5% rich to that. She's going to do that, and that's going to become her capital IQ model. Okay. So you see why you need this, because you need some basis. If you remember that model, let's see if I can bring the model up just real quickly here. If you remember that model, the key piece of it, this is the one but a key piece of this is over here on the right. It's going to be what you think their relative value is going to be. And then you're going to apply that to, so if you do EV to sales, which is probably what Beverly will use, EV to sales, she'll come up, that should be 2.5. She's going to apply that to their last year sales. See if I can find one that's values. Yeah, I don't know why I don't have the model with values, but she's going to apply that to that last cell number. She's going to get the present value of that. That's going to become her valuation. Right now it's set up for EV to EBITDA, but it's really easy for her to change that to EV to sales or PE ratio, whatever. Okay, so if it's PE ratio, you're going to take that PE ratio. If it's, you say they should be trading at 16 times, you're going to multiply that by your earnings per share. That's become your valuation at the end. Right? So it's important that we have this. The other thing she's going to do is she's going to do her graph for valuation. Remember the football chart. She might do something along this line. She might do a percentile 0.2. Sorry. Equal percentile, comma 0.2. She might do that same thing, 0.8. She has to decide, and that's going to give her that range for what she thinks she's going to have on that football chart based on historical relatives. All right, so y'all see the 5 things you're gonna be five. Anybody name them for me, see if anyone's awake tonight?
The football chart?
5 football grids are $10,000 if I can name them, unless I change my mind.
Discounting cash flow.
DCM, all right,
H model,
H,
52-week average.
put that last, but yeah. Not average, I kept saying that, range,
You just sell or
the relative
but
range, yeah.
ending capital entry model.
All right, good, all right, I changed my mind. So that gives you a great looking football chart. It's gonna be really instrumental. You can see how your team is gonna make its final buy sell recommendations and how that's gonna be really, really key to that. You're looking at that chart, you're gonna see very, very quickly which stocks look promising and which ones look overpriced. All right,